Hey guys, Dave Kelly here with StockCharts.com. We couldn't have a live show today on StockCharts TV, my show, The Final Bar, which is every weekday at 4 p.m. Eastern, due to some technical difficulties. So what I wanted to do is just record a brief market update. If we had a live show today, here's what my market update would have included. I just want to share some brief observations because we're at such a pivotal level today. We've been talking for quite some time on my show and in the stuff that I've written on StockCharts.com about the importance of that 4,150 to 4,200 level. That comes from a number of different sources, but primarily it comes from the chart of the S&P 500. That is the June high from early June, right? So we've now retraced 100% of the way back up there. It's also 38.2% of a retracement if you take the September 2020 low, which was the end of that major consolidation zone, January 2022. 38.2% of the way is right there. That level served as support in the first quarter. That was the signal that the bear market was accelerating to the downside in April into May. And I would argue it now confirms that we are back to a relatively bullish constructive pattern as of today. I think today's break above there is meaningful. Here's the thing. I will tell you the same thing today as I told you back here on the swing high in March, which was we've now broken above that level. It's all about the follow through. What follow through means is you have the break, you have a resistance level, you have the break, and then you follow through. And I learned that trick from a lot of people. John Bollinger often talked about that. Many of the technical analysts on the street that I followed when I was just getting started would mention that. Who else? Tom DeMark in particular always talked about follow through and making sure that it's not just trading through a level intraday. You need to close through it and then trade one or two ticks further. And I really took to heart that message because so often we have a key level we're watching. There's the break, and then that's it. And then it fails, and then you go right back through there. And that's exactly what happened in March. We closed above 4,600 for one day. Then the immediate next day was a distribution day, followed by an acceleration to the downside. The next 6 weeks were pretty painful. I don't think necessarily we have a repeat of that, although it's possible. But I would say today is like this day right here in March, where we finally got above that level. But what you have to remember is all the things that have had to happen for that price to rally in March, just like all the things we've had to see in the last 6 to 8 weeks to accelerate the market off of the June lows. Tony Dwyer was on my show not too long ago, but he put out a note this week, basically, talking about the pendulum swinging, right? And it swung to a very bearish place in mid-June. This is when sentiment was bombed out. My conversation with Ari Wald yesterday on my show focused on that as well. And then the pendulum swinging back. And right now, I would argue the pendulum is kind of swinging back to the over bullish camp. A lot of technology stocks, which we'll talk about here in a moment, are overbought, right? They have an RSI above 70. Now, that on its own is not a bad thing necessarily, but it certainly speaks to the acceleration we've got on the upside. We went from being ridiculously bearish, everything's going to zero, to all of a sudden ridiculously bullish, everything's going back to all-time highs all of a sudden. And I don't know if the macro picture has changed for the market to deserve that sort of optimism. I would tell you that the fact that we've retraced, we're up about 15%. I think the S&P maybe a little more than that off of the June lows. It's a pretty strong run higher. Now, granted, this is after a pretty big sell-off, 20 plus 30%, depending on what benchmark you use in the first half of 2022. But we've already gained quite a bit. We've gained a lot off of this June low. So thinking that things look attractive now, and I get it, looking at the individual stocks, there's a lot of constructive patterns, but we've had a pretty decent run, which is why most people I talk to, myself included, think that a meaningful pullback right about now makes a ton of technical sense. I would say that is an important pullback for anyone. If you're bullish or bearish, this will validate all of our perspective. After a market is run like this, totally reasonable to expect a pullback and some sort of swing. And then the question will be, what's next? Do we pull back to 4,000, a short-term pullback? Do we pull back to, make new lows, add a new 30, 650, 30, 600? I think that's possible. But the charts will tell us what's actually playing out. So I would argue we're at a pivotal point right now. If I'm looking at charts and not trying to disconnect from my preconceived bias on these markets, I probably have to be pretty constructive. I think a lot of my caution is from market history and knowing how bear market stages often have this period. And I'll show you the breadth measures in particular, because I think that's an important place to go next. If you look at the Mindful Investor live chart list, We go down here a little bit. This is the cumulative advanced decline lines for the 4 major buckets of stocks: New York Stock Exchange, common stock only, large caps, mid caps, small caps. The NYSE AD line has not quite broken above its June high, but all the others have now done it. Today is when the S&P large cap breadth line actually did break to new highs or new swing highs above the June high. That was just today's session. Not all of these are updated. As I'm looking down, I think some of these, the mid caps and small caps, are quite updated because they're going to uptick here when we finally get the data. But I do think the AD line for the common stock only is updated. I'm not quite sure on that, but that's something I would certainly look at because we're doing this right after the close. I would certainly be following to see if we do get breaks above those levels, because in my opinion, the bull case for stocks involves the S&P getting above 4,200. It involves breadth conditions getting high and staying high. The third piece, it involves volatility getting low and staying low. And we'll look at that one here in a minute. This is the chart I'm using to follow high yield spreads, the VIX, and the S&P 500. We've reviewed the show on my show, reviewed this chart on my show recently, so I don't want to belabor it, but basically high yield spreads are narrowing. The VIX is coming down. I have that plotted, both of those plotted inverted, just how it matches the S&P 500. VIX volatility has decreased, spreads have come in. Those are basically risk-on indications. For the S&P to find resistance here and roll lower, you'd also have to most likely see an increase in volatility and a widening of credit spreads. And that's why I think this chart would be very interesting to track any failure of the S&P to regain 4,200 and hold it. So I think that's an important chart to watch. So it's the price of the S&P getting above 4,200. It's the advanced decline lines confirming a breakout. It's volatility and spreads continuing to remain in a bullish mode, which would mean both of those going lower values in this chart actually sloping higher. And then the final piece of that, to just switch gears just a bit, are all of these names that have had these really nice breakouts would need to hold them. Coinbase might be one of the better examples of a chart that I think has rallied significantly despite the fact that the conditions have actually worsened. Now, a lot of what's being priced into the chart of Coinbase through May and really through June and July has been, obviously the crypto winter, right? The severe weakness in cryptocurrencies. But if you look at Coinbase's earnings release, which was earlier this week, they talked about, low trading volumes, talked about losing, less and less participants in their exchange. All of those things that are negative, lower, weaker sentiment on cryptocurrencies, all of those things would be major headwinds to Coinbase doing well. Coinbase rallying from about 45 to 95 in about 6 weeks is all about that is behind them. And now it's just, it's positive from here out. The chart is pricing in that things are just getting better, that cryptocurrencies recover broadly from here, that a lot of individual investors that have very much cooled off on the idea of trading cryptos suddenly get big time back into it and start building up the volume of transactions on Coinbase. I just don't see enough evidence to validate that as a significant thesis. The thesis of buying Coinbase now is that cryptos have bottomed out and that all the negativity that has caused the risk-off environment has dissipated. I don't think you can say that and be intellectually honest about the evidence that we're seeing elsewhere, which is that conditions are still very challenged, that consumers and market participants still have a lot of headwinds to, just a rosy recovery from here, and that it could still very much be a rocky road. So not to get too much under the fundamentals of Coinbase, but I would tell you charts like this, of which there are many, 80 is a level of resistance, and it gapped above 80 and now is holding it. So the bull case for stocks involves Coinbase holding 80. And I'm sticking with technology. It involves ASAN holding 25. What else would be a good one? PayPal's another good one, right? Holding 90. So these are stocks that have now gapped above or traded above key resistance levels. It's the basic premise, which is a downtrend is now in an uptrend. And I've seen the evidence. Again, the chart of PayPal is at an attractive technical point. It's recovered to a bit. If we look at something like the PPO, which I didn't show on here earlier, it's a nice constructive pattern, most recently giving a buy signal. The concern I have for all of these technology stocks, by the way, is the fact that they're overbought. So the leading indicator in the form of technical analysis is things getting extreme and having extreme moves because those are often unsustainable. Most of the technology stocks I could show you today are at or recently at overbought conditions. And that tells you the severity, the leadership that you've seen from technology off of the lows, but also the challenges of sustaining those gains from there. So the way I would summarize sort of, and again, I should also point out that despite everything I just said, there are always charts somewhere that are breaking out. GPC is my favorite example. Recently, over the last couple of weeks, you've had a series of new 52-week highs after a beautiful basing pattern. What I've learned about charts and technical analysis over my career is that despite whatever is happening in the broader market, whether it's 2001, 2006, 2009, painful periods, wonderful bull market phases, some stock somewhere is always breaking out. And all you need to do is scan for those ideas, have a good technical discipline that helps you layer out of things that are no longer working and layer into things that are working. And I think overall, you're in pretty good shape. So to summarize what I saw from the market today, just to finish off the market recap, just to get into what happened today, the S&P up over 2%, the NASDAQ up almost 3%. So it was leading the S&P. Materials, consumer discretionary, communication services, and technology were the four sort of at the top. And then it was kind of everything else below there, down to utilities, which actually managed to finish the day in the green. The VIX is below 20, which is notable. That is important because, again, the VIX has bottomed out around 20 in all the major tops going back in 2022 for the most part. So the fact that the VIX is back down to that level tells me one of two things. Either this is the ultimate selling opportunity for stocks as we have another failed breakout, just like we did in late March, or this is something different. This is a new volatility regime. Volatility is going to remain muted. We will remain below 2025 for the foreseeable future as we have more of a progressive bull market. I think over the next week or two, we are going to find out which of those is the case. I don't disagree with the argument of taking on risk here because charts are improving. But I would tell you, if you are doing that, then you are minimizing the likelihood of a meaningful pullback as the S&P tests and even breaks above resistance a little bit, as a lot of technology leadership names that have had good runs are overbought. You are fighting a lot of technical evidence if you're buying at this particular moment. So I think no matter what, a pullback is most likely in the cards. With other asset classes, very quickly, by the way, interest rates coming off. My conversation with Ari Wald yesterday was a really good one where we talked a lot about interest rates and what that means, if and when rates would remain lower. Commodities had a pretty decent day, except for gold, which was down a little bit. Everything else is positive. The cryptocurrencies continue to push higher. And again, I see the argument with cryptocurrencies rallying, but if you look at the longer term chart of Bitcoin, it is not in an uptrend yet. In my opinion, of my evaluation of the evidence, it's a rally within a downtrend, in a secular downtrend, or at the very least a cyclical downtrend. And this is a rally within the context of a longer downtrend phase. I think that's it. The other thing I would mention, cruise lines popping beautifully today. And again, I'm be impressed by short-term gains. Be more impressed when short-term gains turn into longer-term transformational rallies. So while the chart of RCL has bounced beautifully from around 30 to just over 40, that's a decent rally in a short period of time. We're just getting to the 50-day moving average, which we closed above. We're just getting to the June high. So again, I'm interested in stocks that are breaking above their June highs. I am skeptical on their ability to hold those levels. And I think the moment you see some of those breakouts that have occurred, particularly with the S&P 500, if and when they pull back and start to fail, if and when that would happen, I think there's a flight to the exits very, very quickly when investors realize that was the rally and now we retest. And I think a lot of our attention could be focusing on what a potential retest of the lows look like, or if we bottom out on the way down there. And that's where I think as technical analysts, we will have our hands full trying to gather the evidence and make sense of it. Long story short, 4,200, an impressive break. I'm looking for whether that break can be sustained, whether we have follow through going through the remainder of this week and into next week. That was it. That's a brief market recap. And again, apologies we couldn't have a live show today, but thanks again, as always. And keep your questions coming, by the way. The final bar at StockCharts.com is my Q&A email for my live show, and we'll answer questions from the mailbag again on Friday. I'm Dave Keller from Market Misbehavior and StockCharts.com. Take care. Bye now.